Ladies and gentlemen, 2026 didn't arrive quietly, it arrived with force. Barely days into the new year, global markets were jolted by a sequence of high-impact events that immediately shifted risk perception across the world. A dramatic U.S. military operation removed Venezuela's long-standing leadership, sending shockwaves through geopolitics, energy markets, and investor psychology. This wasn't just another headline, it was a reminder that the world has entered a far more unstable phase, one where political decisions and military actions now move markets faster than earnings reports ever could. And when instability rises, capital does what it has always done throughout history. It runs toward safety. That's why precious metals are no longer a niche trade or a fringe hedge. They are becoming central to the global financial conversation once again. To help break down what's unfolding beneath the surface, we turn to a market veteran who has seen multiple cycles, crises, and monetary experiments come and go. Todd Bubba Horowitz, longtime trader and chief market strategist. His outlook for this year is not subtle, it's not cautious, and it's certainly not popular in polite financial circles. Gold, he believes, is not done moving. Silver, he argues, is only just beginning to wake up. And the reasons have nothing to do with hype. They have everything to do with debt. Because at the core of today's financial system sits an uncomfortable truth. The modern economy is built on leverage, borrowing, and promises that require constant expansion just to survive. Government debt is expanding, corporate debt is expanding, household debt is expanding, and history is very clear about what happens next. Hard assets thrive when confidence in paper weakens. Precious metals don't require earnings growth. They don't rely on management credibility. They don't depend on central bank promises. They exist outside the system. That's why gold has already been pressing toward record territory, and why silver is finally breaking free from decades of suppression. One of the most important signals confirming this shift is the collapse in the gold to silver ratio. Not long ago, it took more than 100 ounces of silver to equal the value of a single ounce of gold. Today, that ratio has nearly been cut in half. This isn't random. It's the market acknowledging that silver is no longer just a monetary metal. It has become an essential industrial input at the exact moment global manufacturing is being restructured. Solar technology, energy storage, advanced electronics, defense systems, all of them rely on silver, that dual role, monetary protection and industrial necessity, or is what makes silver uniquely explosive in this environment. But here's the key distinction most people miss. There's a difference between being bullish and being reckless. Even in strong secular trends, markets don't move in straight lines. Pullbacks happen, corrections reset positioning, volatility shakes out weak hands. Long-term conviction does not mean short-term impatience. This is where experience matters. Someone investing for the next decade can tolerate fluctuations. Someone chasing momentum with leverage cannot. Understanding that difference is what separates wealth building from wealth destruction. And that distinction matters more than ever because the structural forces driving metals higher are not temporary, they're systemic. Inflation is not transitory, debt is not manageable, and the global fiat currency system is under strain everywhere at once. For decades, the world operated under an illusion that money could be created endlessly without consequence, that deficits didn't matter, that purchasing power erosion was manageable. But reality always catches up. When currencies lose credibility, societies don't collapse overnight. They adjust, they reprice, and they migrate towards stores of value that cannot be diluted. This is why silver's role is expanding beyond charts and into history. Unlike gold, silver has always been the bridge between everyday commerce and monetary stability. It's small enough to circulate, accessible enough to be used, and scarce enough to retain value. That's why it's often called the people's metal. If confidence in fiat systems continues to erode silver, doesn't it just rise in price? It rises in relevance. And relevance is far more powerful than speculation. This isn't theory. History has already shown us what happens when governments abandon monetary discipline. Once currencies are severed from tangible backing, the temptation to print becomes irresistible. The break from the Bretton Woods system in the 1970s was a turning point. From that moment on, money was no longer anchored. It was managed. And to manage systems always favor those closest to the controls. Central banks gained unlimited power. Debt became policy. Inflation became a tool, not a failure. That's why prices rise faster than wages. That's why savings lose purchasing power. And that's why asset ownership increasingly defines economic survival. You don't need to believe in conspiracy to see the consequences. You only need to look at math. $1 today buys far less than it did even a decade ago, and that trend is accelerating, not reversing. Meanwhile, precious metals continue to do what they've always done: preserve value across time, not perfectly, not smoothly, but reliably. This is why the discussion around silver is changing. It's no longer just about price targets, it's about function. What protects purchasing power? What survives systemic stress? What remains valuable when trust erodes? Those questions matter more in 2026 than they have in generations, and this is just the first layer of the story. Because behind the metals rally sits a deeper issue, the currency itself. In the next part, we're going to confront the elephant in the room, the US dollar, global debt, and the illusion of strength that masks long-term decay. We'll break down why a currency can appear strong while losing value, why debt servicing is not the same as solvency, and why the next phase of this cycle will force choices most investors are not prepared for. This is not about fear, it's about preparation. On the surface, everything looks fine. The dollar appears strong, US markets still dominate global capital flows. Government officials continue to insist the system is resilient, but strength on paper is not the same as strength in reality. In fact, one of the most dangerous misconceptions in finance is the belief that a rising currency automatically signals a healthy economy. History tells a very different story. Currencies can rise for many reasons, and some of them are deeply troubling. The dollar today is strong not because the system is stable, but because alternatives are weaker. Europe struggles with stagnation, emerging markets drown under dollar-denominated debt, global capital has fewer places to hide. So it runs to the least bad option. That does not make the system sound, it makes it fragile. Because beneath the surface of dollar strength lies a mountain of obligations that grows larger every single day. Debt is no longer a temporary tool. It is the foundation of the system itself. Governments borrow to fund operations. Corporations borrow to survive thin margins. Consumers borrow just to maintain lifestyles that inflation has made unaffordable. And here's the critical issue most people overlook. Debt doesn't disappear, it compounds. Every dollar borrowed today requires future dollars to service it. But those future dollars must be created somewhere. And increasingly, they don't come from productivity. They come from expansion of the money supply. This is the trap. To keep the system running, more currency must be created, but creating more currency weakens purchasing power. Weak purchasing power requires higher wages and higher borrowing. Higher borrowing demands even more currency creation. It's a loop, and loops eventually break. This is why interest rates are such a problem. Raising rates slows inflation, but increases debt servicing costs. Lowering rates eases debt pressure, but accelerates currency debasement. There's no painless option anymore. Every choice carries consequences. For decades, policymakers delayed this reckoning by exporting inflation globally. The dollar's reserve status allowed the US to run deficits without immediate penalty. Other nations absorbed the pressure. But that dynamic is changing. Countries are increasingly settling trade outside the dollar. Central banks are diversifying reserves. Trust is thinning, quietly, steadily. Reserve currencies don't collapse overnight. They erode. And erosion is subtle enough that most people don't notice until the damage is advanced. That's why people misunderstand inflation. Inflation isn't just prices going up, it's purchasing power going down. When your currency buys less every year, your labor is being discounted, your savings are being taxed silently, and your future purchasing ability is being transferred to the issuer of the currency. This is not theory, it's arithmetic. And when enough people realize this, not intellectually but emotionally, behavior changes. That's when capital moves, not into speculative assets, not into promises, but into things that cannot be printed. This is where precious metals re-enter the conversation. Gold protects wealth at the top, silver protects mobility and access at the bottom, and both function as a referendum on trust. When trust in institutions weakens, metals rise. When trust strengthens, metals consolidate. Right now, trust is being tested everywhere. Political instability, geopolitical conflict, monetary experimentation, social pressure. These forces don't operate independently. They reinforce each other and markets feel it. One of the most revealing signals is how quickly liquidity disappears during stress, when volatility spikes assets that depend on confidence collapse first, assets that depend on scarcity hold. This is why silver's volatility is often misunderstood. Yes, it moves fast. Yes, it corrects sharply. But volatility is not weakness. Volatility is information. It reflects a market that is small relative to global demand, a market where even modest capital flows can produce outsized moves. Silver is not manipulated because it's weak, it's sensitive because it's scarce. That sensitivity cuts both ways. It punishes impatience, but it rewards conviction. And conviction is built on understanding cycles. We are not in a normal economic slowdown. We are in a transition. From growth fueled by leverage to survival defined by resilience. In that transition, paper assets compete for attention, while real assets compete for trust. And trust is finite. This is why timing matters less than positioning. Trying to trade every move in a structurally broken system is exhausting and dangerous, but owning protection before it's universally recognized is strategic. There's an old saying, markets move to punish the maximum number of participants. In the next phase, complacency will be punished. Those who believe central banks can indefinitely control outcomes will be surprised. Those who assume debt can grow forever without consequence will be disappointed. And those who think inflation is over may soon learn the difference between slowing price increases and restored purchasing power. They are not the same thing. Even if inflation rates decline, prices don't reset downward, the damage remains. The standard of living does not automatically recover. That's why this moment matters. Not because collapse is imminent, but because transition is underway. And transitions reward preparation. How to think about metals allocation, why patience beats leverage, and how history repeats. Not exactly, but rhythmically. Because understanding the rhythm is what allows you to move ahead of the crowd instead of reacting behind it. At this point, the question is no longer what's happening. The real question is, what do you do about it? Because awareness without strategy leads to anxiety, and fear without structure leads to bad decisions. This is where most people fail, not because they lack information, but because they lack a framework. In uncertain times, the goal is not to predict the future perfectly. The goal is to remain solvent, flexible, and positioned, while others are forced to react. That's the difference between preparation and speculation. Let's start with a hard truth. There is no single asset that solves every problem. Gold will not make you rich overnight. Silver will not move in straight lines. Cash will not protect purchasing power long term. Stocks will not always outrun inflation. Each tool has a role, but only if you understand why you're holding it. Precious metals are not about maximizing returns. They're about minimizing regret. They exist to perform when confidence breaks, when systems strain, and when liquidity becomes selective. That's why allocation matters more than obsession. You don't need to bet everything, you need to balance exposure. For most people, the mistake isn't owning too little metal, it's expecting metals to behave like tech stocks. That expectation leads to frustration during consolidations and panic during pullbacks. But metals aren't growth assets, they're anchors. And anchors don't move quickly. They hold when everything else drifts. Silver in particular requires patience. Its volatility tempts traders to overleverage. Its headlines lure speculators at peaks, and its corrections punish those who confuse conviction with timing. The disciplined approach is boring, and that's exactly why it works. Gradual accumulation, no leverage, no desperation. Position first, price second, because when the system reaches a point of stress, it doesn't ask whether you bought perfectly. It only asks whether you're exposed. Another mistake people make is focusing exclusively on short-term narratives. Yes, geopolitics matter. Yes, elections matter. Yes, central bank meetings move markets. But these are catalysts, not causes. The cause is structural. A system dependent on perpetual debt expansion cannot reverse course without pain. It can only delay consequences, and delays increase magnitude. That's why patience is such a powerful edge right now. Most market participants are conditioned for speed. Fast trades, instant reactions, constant stimulation, but structural shifts don't reward speed. They reward endurance. History confirms this again and again. Wealth doesn't transfer during calm periods. It transfers during transitions. And transitions are uncomfortable by design. This is why emotional discipline is just as important as asset selection. When prices spike, greed whispers urgency. When prices drop, fear screams failure. Both voices are wrong. The correct response is neutrality. Observe, adjust, hold conviction without attachment. That mindset is rare, and rarity creates advantage. Now let's address the elephant in the room. What if nothing breaks? What if the system limps forward for years? What if inflation moderates? What if markets continue to function? That's not a failure of this strategy, because metals are not a bet against stability. They are insurance within uncertainty. If nothing breaks, metals consolidate while other assets perform. If something breaks, metals perform while others scramble. Either way, optionality is preserved. That's the goal. Optionality means choices. Choices mean power. And power is what erodes first in debt-driven systems. The final piece of this puzzle is mindset. People often ask, is now the right time? The honest answer is uncomfortable. There is no perfect time. Only prepared people. Those waiting for clarity usually arrive late. Those demanding certainty usually overpay. Those seeking permission usually miss opportunity. Preparation doesn't feel heroic. It feels quiet, and quiet strategies rarely trend on social media. But when volatility accelerates, and it always does, quiet preparation reveals its value. That's when leverage fails. That's when narratives collapse. That's when fundamentals reassert control. And fundamentals always favor scarcity over promises. This doesn't mean abandoning modern finance. It means anchoring yourself against its weaknesses. A balanced approach doesn't reject innovation. It respects history. Because history never repeats exactly, but it always rhymes. Empires rise on trust and fall on debt. Currencies expand, then dilute. Hard assets disappear, then return. We are not witnessing something new. We are witnessing something familiar, only faster, larger, and more interconnected. That's why this moment feels confusing. Complexity obscures simplicity, but the core truth remains unchanged. You cannot print value. You cannot borrow prosperity, and you cannot suspend consequences forever. The future will not reward panic, it will not reward denial, and it will not reward blind optimism. It will reward positioning, not aggressive positioning, not emotional positioning, strategic positioning. And that's where precious metals quietly belong, not as saviors, but as stabilizers, not as trades, but as tools. When the dust settles, and it always does, the winners are rarely the loudest voices. They are the ones who prepared while others debated. That's the opportunity of this era, not fear, not collapse, transition. And transitions belong to those who understand them before they're obvious.